Fortuna Mining has undergone a transformation throughout the 2024 and 2025, transitioning from a diversified silver and gold producer with aging assets to a streamlined gold-dominant enterprise focused on high-margin, long-life operations in West Africa and Latin America. This strategic reorientation was concluded in mid-2025 with the divestiture of the San Jose Mine in Mexico and the Yaramoko Mine in Burkina Faso, which were characterized by escalating cost profiles and declining reserve grades. Fortuna Mining has now concentrated its financial resources on assets with higher geological potential and lower all-in sustaining costs, most notably the Séguéla Mine in Côte d'Ivoire and the Lindero Mine in Argentina. The financial performance in the third quarter of 2025 was strong. Fortuna achieved a realized average gold price of $3,467 per ounce, a 20% increase from the first quarter of the year, which served as a significant tailwind for the company's margin expansion. Attributable net income for the quarter reached $123.6 million, or 40 cents per share, a figure that includes a substantial $69 million impairment reversal at the Lindero Mine. This impairment reversal is a critical indicator in the long-term economic viability of the Argentine operations, particularly under a modernized regulatory framework and a higher long-term gold price environment.
The current portfolio structure allows the company to operate with a balance sheet boasting total liquidity of $588 million and a strengthening net cash position of $266 million as of late 2025. This financial flexibility is important as the company advances its next major organic growth project, Diamba Sud in Senegal, which is projected to contribute an average of 147,000 ounces of gold annually during its first 3 years of production. Detailed asset evaluation and operational dynamics. Séguéla Mine, the growth engine. The Séguéla Mine in Côte d'Ivoire has rapidly established itself as the cornerstone of Fortuna's production profile. In the third quarter of 2025, the mine produced 38,799 ounces of gold, maintaining its status as the company's highest producing and lowest cost primary gold asset. While the cash cost for the quarter was a remarkably low $688 per ounce, the all-in sustaining cost, or AISC, rose to $1,738 per ounce. This increase in AISC was not a result of operational inefficiency, but rather a strategic alignment with higher gold prices, which triggered elevated royalty payments, and the timing of essential capital investments designed to support a significant production expansion in 2026. The 2026 production guidance for Séguéla is set between 160,000 and 180,000 ounces of gold, representing a significant increase from the 2025 target. This growth is underpinned by an extension of the reserve life to 7.5 years, a result of the brownfield exploration. The company has initiated a processing plant expansion study, awarded to Lycodium Minerals Canada, which aims to increase throughput from the current 1.75 million tons per annum, or MTPA, to between 2 and 2.5 MTPA. This 15 to 40% capacity increase is intended to unlock the value of newly identified mineralization, particularly the high-grade underground potential at the Sunbird deposit.
Geologically, Séguéla continues to exceed expectations. Exploration at the Sunbird Underground project has focused on converting indicated mineral resources, currently estimated at 3.6 million tons at 4.34 grams per T, containing 502,000 gold ounces, into mineral reserves. The results from 5 drill rigs operating at Sunbird in late 2025 are expected to feed into a December 2025 resource update, which will likely serve as the foundation for underground mining operations slated to commence in 2027. Furthermore, the Kingfisher deposit, located only 1 kilometer from Sunbird, has also shown significant potential, with recent drilling intersecting 4.5 grams per TAU over 37.4 meters. Lindero Mine, stability and economic reevaluation. The Lindero Mine in Argentina is an open-pit heap leach operation that has transitioned from its ramp-up phase into a period of stable, high-margin production. In Q3 2025, Lindero produced 24,417 ounces of gold. The operation's cash cost was $1,117 per ounce, with an AISC of $1,570 per ounce, trending lower toward a stabilized range of $1,500 as key investments such as the leach pad expansion completed in early 2025 begin to yield efficiencies. The $69 million impairment reversal recorded in 2025 is a watershed moment for the asset. This reversal, which essentially recovers the full impairment charge taken in 2022, was driven by a revised long-term gold price assumption of $2,750 per ounce and a disciplined 8.2% discount rate in the company's discounted cash flow modeling. The reversal signifies that the recoverable value of the mine now exceeds its carrying value, a testament to both the improved metal price environment and the mine's consistent operational delivery. Brownfield exploration at Lindero remains a priority, with a $3.4 million budget for 2025 focused on targets like the Arizaro prospect. The objective is to identify satellite mineralization that can leverage the existing processing infrastructure, thereby extending the mine life and enhancing the project's net present value without substantial new capital requirements.
Caylloma Mine in Peru continues to provide Fortuna with valuable product diversification through its output of silver, lead, and zinc. For 2025, the mine is targeted to produce between 0.9 and 1.0 million ounces of silver, 29 to 32 million pounds of lead, and 45 to 49 million pounds of zinc. In the third quarter of 2025, the operation recorded a cash cost per silver equivalent ounce of $17.92 and an AISC of $25.17. While silver production saw a 24% year-over-year decrease in Q3 2025, this was largely a result of mine sequencing and head grade variability. Despite these fluctuations, Caylloma remains a steady cash flow contributor, benefiting from high silver prices and robust demand for base metals. The mine serves as an important hedge within the portfolio, providing a revenue stream that is not entirely correlated with the gold market. Cash flow analysis. Historical trends and operating cash generation. Fortuna Mining's cash flow generation profile has undergone a structural shift, moving from a position of heavy capital investment to one of robust free cash flow harvest. For the 9 months ended September 30, 2025, the company generated $293.0 million in net cash from continuing operations, a 66% increase from the $136.5 million generated during the same period in 2024. This growth is primarily attributed to the full contribution of the Séguéla Mine and the higher realized gold prices throughout 2025.
In the third quarter of 2025 alone, net cash from operating activities reached $111.3 million, up 65% from the third quarter of 2024. When excluding changes in working capital, the figure was $113.9 million, or 0.37 cents per share, which exceeded analyst consensus. This level of cash generation includes the $13.6 million in withholding taxes paid during the quarter, which were related to the repatriation of $118.2 million from subsidiaries in Argentina and Côte d'Ivoire. Working capital dynamics and tax implications. A critical factor in the improved cash flow performance has been the stabilization of working capital. In 2024, the company experienced a significant $60.9 million drain on cash from working capital changes. However, in the first 9 months of 2025, this drain was reduced to $14.8 million, suggesting that the company has optimized its inventory cycles and receivables management following the divestiture of its more complex, higher-cost legacy assets. Income taxes paid have increased significantly alongside profitability, rising to $80.4 million in the first 9 months of 2025 from $34.1 million in the prior year. This reflects the transition of the Séguéla Mine into a tax-paying entity and the overall higher taxable income across the group. Interest paid, conversely, has decreased from $11.0 million to $5.4 million over the same period, reflecting the company's debt management and the absence of new high-interest debt issuances. Free cash flow from ongoing operations reached $73.4 million in the third quarter of 2025, more than doubling the $34.0 million reported in Q3 2024. This free cash flow generation is the primary engine behind the company's ability to fund its growth pipeline. In the first quarter of 2025, the company achieved a record free cash flow margin over sales of 38%, illustrating the high degree of operating leverage inherent in the current portfolio. Capital allocation is strictly prioritized toward organic growth and balance sheet strength. Total capital expenditures for Q3 2025 were $48.5 million. This includes sustaining capital for ongoing mine site development and growth capital for the expansion at Séguéla and early works at Diamba Sud.
The company's liquidity position of $588 million ensures that it can easily accommodate the estimated $283.2 million initial capital cost for the Diamba Sud project without resorting to external financing. Balance sheet analysis. Asset quality and liquidity position. The Fortuna balance sheet as of September 30, 2025, reflects a position of financial health and asset quality. Total assets were valued at approximately $2.24 billion, with current assets comprising $647 million of that total. The liquidity position is headlined by a cash balance of $438.3 million, an increase of $51 million from the second quarter of 2025.
The value of mineral properties and property, plant, and equipment stood at $1.52 billion. The stability of this value is a function of the company's reinvestment strategy and the reversal of impairments. The Lindero impairment reversal of $52.7 million, net of depreciation, directly bolstered the carrying value of the company's mining assets, reflecting their improved long-term economic outlook. Trade and other receivables were $83.4 million, while inventories were maintained at a lean $110.7 million, down from $134.5 million at the end of 2024, signaling efficient stock management. Liability structure and debt management. Fortuna has maintained a conservative approach to leverage. Total liabilities as of late 2025 were $569.6 million, a decrease from the $649.5 million reported at the end of 2024. Total debt, including senior notes and lease obligations, was $132.2 million. This results in a debt-to-equity ratio of only 7.9%, which is among the lowest in the intermediate producer peer group. The interest coverage ratio of 65.9x underscores the negligible risk associated with the company's debt service obligations. Furthermore, the company's net cash position, calculated by subtracting total debt from cash and short-term investments, stood at $265.8 million, up from $214.8 million in the second quarter of 2025. This net cash position provides a significant buffer against potential commodity price volatility and allows for rapid decision-making regarding growth capital investments. Non-current liabilities also include $48.2 million in closure and reclamation provisions, which have decreased from $70.8 million at the end of 2024. This reduction is largely due to the divestiture of the San Jose and Yaramoko mines, which allowed the company to avoid approximately $50 million in future closure costs. This strategic avoidance of long-term liabilities is key, as it benefits the company's portfolio optimization. Shareholders' equity and retained earnings. Total equity as of September 30, 2025, was $1.67 billion, with equity attributable to Fortuna shareholders reaching $1.62 billion. Share capital remains stable at approximately $1.13 billion, while retained earnings grew significantly to $428.5 million from $216.4 million at the end of 2024. This growth in retained earnings is a direct reflection of the company's strong net income performance throughout 2025. The company's book value per share is approximately $6.58 CAD, providing a solid floor for the company's market valuation. Valuation analysis. Multiples and relative valuation. Fortuna Mining's current market valuation appears to be lagging behind its operational and financial reality. Despite a surge in the share price throughout 2025, the stock continues to trade at multiples that are attractive relative to its peers. The forward price-to-earnings (PE) ratio is approximately 11.7 times, which is significantly lower than the U.S. metals and mining industry average of 25 times. On an enterprise value basis, the company trades at an EV/EBITDA multiple of approximately 4.3 to 4.6 times. This conservative valuation is highlighted when compared to a broader peer group average of roughly 23.37x for PE and 7.3 to 10.0x for EV/EBITDA for intermediate producers. The market currently prices Fortuna at an EV to sales ratio of roughly 2.2x, while the industry average stands closer to 4.5x. This suggests that investors are still discounting Fortuna's growth prospects, possibly due to perceived jurisdictional risks in Argentina and West Africa. Peer comparison and P/NAV sensitivity. When analyzed on a price-to-net asset value (P/NAV) basis, Fortuna trades at approximately 0.83x, placing it in line with peers like New Gold, and slightly below larger producers such as Agnico Eagle, which often commands a premium of 1.38x. Intermediate peers like Aris Mining and Torex Gold trade at P to NAV multiples of 0.67x and 1.02x respectively, with Aris often carrying higher leverage, which explains its discount. Fortuna's valuation is highly sensitive to the long-term gold price assumption. Using a consensus gold price of $2,750 per ounce, the intrinsic value estimated by various analyst models suggests a fair price of approximately $13.73 per share, indicating that the stock is currently trading at a discount even after its recent price appreciation. More optimistic discounted cash flow models, which fully factor in the potential of Diamba Sud and the Séguéla plant expansion, suggest a fair value significantly higher, though these figures often assume a continuation of record-high metal prices.
Analyst ratings and price targets. Wall Street sentiment toward Fortuna remains cautiously optimistic, with a consensus rating of hold to moderate buy. Out of 7 analysts recently surveyed, 4 have given a buy rating, 2 a hold, and 1 a sell. The average 12-month price target is approximately $9.50 to $9.54, with some high targets reaching $11. Recent upgrades, such as those from Scotiabank moving from sector perform to sector outperform, reflect growing confidence in the company's ability to deliver on its 2026 production expansion targets. Analysts are particularly focused on the upcoming feasibility study for Diamba Sud and the results of the Séguéla expansion study, both of which are expected in the first half of 2026 and are viewed as major valuation inflection points. Strategic growth projects, Diamba Sud and expansion studies. The Diamba Sud Gold Project PEA. The Preliminary Economic Assessment PEA for the Diamba Sud project in Senegal, released in October 2025, outlines a project with potential for high returns. At a gold price of $2,750 per ounce, the after-tax net present value is estimated at $563 million, with an internal rate of return (IRR) of 72% and a payback period of just 10 months.
The initial construction capital cost is projected at $283.2 million, which the company is well positioned to fund through its $588 million in total liquidity. The project is expected to deliver an average of 147,000 ounces of gold per year during the first 3 years of production at an AISC of $904 per ounce. This would significantly lower the consolidated group AISC, further enhancing Fortuna's overall margin profile. The Senegalese government's 10% free carried interest is a standard component of the jurisdiction's mining code, as is the option for the state to purchase an additional 25% contributory interest. While these factors reduce the total attributable NPV to Fortuna, the Analyst project's economics ensures that it remains a highly accretive growth opportunity. Expansion studies at Séguéla. Complementing the growth at Diamba Sud is the ongoing work to maximize output at Séguéla. The processing plant expansion study aims to evaluate increasing throughput capacity to a range of 2.0 to 2.5 million tons per annum. This expansion is critical to accommodate the anticipated influx of high-grade underground ore from the Sunbird deposit. By aligning processing capacity with potential underground feed, Fortuna aims to ensure that future increases in mineral reserves can be efficiently treated on-site. The target for this expansion is to achieve an annual gold production of more than 200,000 ounces from Séguéla alone. This initiative supports Fortuna's overarching strategic objective of reaching approximately 500,000 ounces of annual gold equivalent production within the next 3 years.
Risks and jurisdictional dynamics. Operational risks and cost pressures. Fortuna faces the standard suite of operational risks inherent in mining, including geotechnical stability, grade variability, and metallurgical recovery. At Séguéla, the stripping ratio increased to 14.6 to 1 in 2025, which, while planned, highlights the necessity of disciplined cost management as the mine matures. Any unforeseen increases in sustaining capital requirements could pressure margins if gold prices soften. Furthermore, the share-based compensation (SBC) expense remains a volatile component of general and administrative costs. In Q3 2025, the rise in Fortuna's share price led to a $6.3 million increase in SBC expense, impacting the adjusted net income by approximately 0.04 cents per share. While this is a non-cash expense that reflects the positive performance of the equity, it can create noise in the quarterly earnings results. Argentina's regulatory and economic landscape. Operating in Argentina continues to require careful management of both regulatory and macroeconomic risks. The Large Investment Incentive Regime, RIGI, provides a stabilizing framework for projects exceeding $200 million, offering 30-year fiscal stability and a reduced corporate income tax rate of 15%. However, smaller-scale projects that do not meet the $200 million threshold must rely on the Legacy Mining Investment Law, Law 24196, which the Malay administration is currently working to modernize.
The potential for currency devaluation remains a risk, as evidenced by the $5.6 million foreign exchange loss at Lindero in Q3 2025 due to a 14% devaluation of the peso. While the Argentine Central Bank has announced plans to loosen currency trading restrictions and rebuild reserves starting in 2026, the transition toward a fully dismantled capital control regime remains a work in progress. Geopolitical stability in West Africa. Fortuna's increasing footprint in West Africa brings both high rewards and significant geopolitical risks. Senegal and Côte d'Ivoire are generally considered stable mining jurisdictions compared to their regional neighbors. However, timelines for permitting and changes in fiscal terms are always subject to political shifts. While Senegal and Côte d'Ivoire are established mining hubs, they are subject to shifting fiscal terms. Senegal is currently revising its mining code, with a new bill targeted for adoption by the end of 2025 that aims to increase state benefits and could potentially alter existing agreements with producers. The robust economic projections for the Diamba Sud project in Senegal are currently based on a preliminary economic assessment, or PEA. This assessment relies on inferred mineral resources, which are geologically speculative and cannot be considered proven reserves until a definitive feasibility study is completed, targeted for mid-2026.
Asset concentration. Following the 2025 divestiture of the San Jose Mine in Mexico and the Yaramoko Mine in Burkina Faso, Fortuna has transitioned to a more concentrated asset portfolio. This increases the company's vulnerability to localized disruptions, such as equipment failure, environmental incidents, or social unrest at its primary sites in Côte d'Ivoire and Argentina. Conclusion. The strategic positioning of Fortuna Mining Corp heading into 2026 reflects a company that has optimized its asset base to capture the maximum benefit from a high precious metals price environment. The transition from high-cost legacy assets to low-cost, high-growth operations like Séguéla and Lindero has transformed the company's financial profile, resulting in record free cash flow. The growth catalysts are the production expansion at Séguéla to 160,000 to 180,000 ounces in 2026 and the anticipated construction decision for the high-return Diamba Sud project in Senegal. These initiatives, coupled with a disciplined approach to capital allocation and a conservative debt profile, suggest that Fortuna is well-positioned to continue its upward trajectory. While risks regarding jurisdictional policy and commodity price volatility remain, the company's current valuation multiples provide a margin of safety and an opportunity for investors seeking exposure to a high-quality, growth-oriented intermediate gold producer.